Assalamu alaikum wa rahmatullah, and a very good day to all viewers out there. Welcome back to my video presentation on the statement of cash flow. As I promised, this third video, which is going to be covering the presentation of statement of cash flow using the direct method. So let us start. So as you know, there are two methods available. The indirect method, this will be discussed in the next video, but today's video will be focusing on the presentation of cash flow using the direct method. So for a financial statement, it will normally start by having the name of the business entity, the name of the company, or the name of the entity which refers to the reporting entity. Then there will be a title. The title is the statement of cash flows for the year ended. If the year end is 31st of December or calendar year, you have to put the calendar year. If your year end is not the calendar year, let's say 30th of June, you will have to put it 30th of June, for example, 30th of June 2020. And if it ends 30th of June 2020, it will start on 1st of July 2019. So if that is for a non-calendar year. You can also have other date to be your reporting date. And that period is called reporting period. So for your information, statement of cash flow is being prepared for a reporting period. So it has three types of activities if you watch my previous videos, which are the cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. However, in this video, I will also further develop or further explain this direct method or the presentation of statement of cash flow using direct method by putting 4 sections, where section 1 will be covering on what are those information or transaction, or what are those items that need to be taken into consideration to prepare the cash flow from operating activities. This is in section 1. I put this yellow here. Second part is section 2. Section 2 will be discussing the presentation under investing activities. Section 3 will be discussing the presentation under financing activities and what are those examples that can be included in this so-called cash flow template that I've prepared. And the last section is the important section, which is the section on the cash and cash equivalent. And at the bottom of the last section, there is a schedule, which is the cash and cash equivalent schedule that is normally prepared to accompany the cash flow statement. So let's start. And normally what you can do is, if you prepare this statement of cash flow, and we know that there are 4 sections, you normally be given a statement of profit or loss, a statement of financial position, and other accounting records, maybe some additional information. But for today, we're not doing the calculation part or the preparation part. As I said, the video here is presentation of cash flow using the direct method. I'll go into detail each of the line item in the statement of cash flow where necessary. Let's look at the first item or first activity. This is the cash flow from operating activities. If you look here in this note that I provide here, it is primarily derived from the principal revenue producing activities. These are like just those revenue coming from sale of goods, coming from also the business operation. Not necessarily revenue, but it can also relate to whatever payments that you need to meet as part of your business operation activities. So it is derived from the revenue producing activities mainly, but these will not include investing and financing activities. Another way of discussing this is by discussing it bottom up, where we can start off looking at first what are the investing activities, right? And what are the financing activities? and later we will focus on what are the operating activities, right? So I'm going to do that, where I'm going to skip section 1 by going to section 2 first and section 3. Whatever activities that does not mesh under section 2, which is investing activities, and section 3, which is the financing activities, will then be included in the cash flow from operating activities. Because if you can focus on what I put here, yeah, it is that under the standard, it says that these are whatever activities that are revenue producing activities other than those that are not investing and financing. So we will discuss investing activities and financing activities, then we'll come back to this. So what you need to know is that these are the things that we will discuss later. So let's go and look at the section 2. So under section 2, we are going to look at cash flow from investing activities. What are cash flow from investing activities? From the standards, from the lecture that you may have watched and studied, you may notice that this will talk about acquisition and disposal. Acquisition and disposal of a long-term non-current asset and long-term investment other than cash equivalent, cash and cash equivalent. So these investing activities that you need to include in these rows under the investing activities are whatever activities that will represent the extent to which your expenditure have been made to generate future economic benefits, and that generation of future economic benefits with cash flows effect, right? So this will normally focus on the expenditure that will result in a recognized non-current asset, or maybe focus on the disposal of an asset that will also bring in cash proceed, disposal of non-current asset. And it will also include the dividends and interest income received from investment in other companies. Those are under investing activities. Let's go to the detail now. Okay, the first one, cash proceed from disposal of non-current asset. Disposal of non-current asset here is normally derived from your statement of profit or loss, your statement of financial position, maybe some disclosure notes to the account, or any accounting records or any additional information relating to the decrease in the long-term non-current asset that has cash receipt effects. This is relating to items like cash proceeds from property, plant and equipment. So you're going to have a row here. You will write here cash proceeds from property, plant and equipment, or you would say disposal of property, plant and equipment. If it's investment property, which is under IAS 40, MFRS 140, investment property, you would include that as a disposal of investment property here. You write that specifically. Intangible assets like patents, trademark that you acquired, maybe other intangible asset like customer lease that you acquired, or any other intangible asset like rights if you acquired. Yes, it will be included, but here we are not talking about what you acquired, what you dispose, right? So the disposal should be put separately from the acquisition. So we're now talking about what caused the decrease in the non-current asset for intangible asset. And also on the development expenditure, that maybe you decide that you are going to not capitalize here. This one is development expenditure that you will have to, you need to do some correction here. Development expenditure that you are going to de-recognize. Biological assets that you will dispose, and you need to do that You need to do that by adjusting and excluding the non-cash item. By excluding the non-cash item. Okay, non-cash item, as you know, non-cash item are those items that does not affect cash flow. So second one is also relating to disposal. This is disposal of non-current asset, but I'm putting this separately because this is disposal of investment. So investment which are more than 3 months are normally included under investing activities. If you dispose, you sold off the investment, those cash that you receive is what you include here. The cash that you has debited to your bank account as a result of disposal. However, you must take into consideration if there are any non-cash items that shouldn't be included, like gain or loss on disposal. The next one is regarding the acquisition or purchase of the non-current asset, and our focus here is both non-current asset, either the non-current tangible or non-current intangible. So where do you derive that information to find this cash payments of acquisition of non-current asset? As I mentioned, that can be derived from SOPL. You can go and check the information that might be relevant. SOFP, statement of financial position. SOPL is statement of profit or loss. Disclosure notes to the account. Maybe the movement of property, plant and equipment, movement of intangible asset, movement of investment property, the notes accompanying them, accounting records, and additional information relating to the increase in the long-term non-current asset. When there is an increase in long-term non-current asset here, these are related to maybe items like property, plant and equipment that was purchased for cash. You debit PPE, you go and credit your bank account, so that will have an outflow of cash. Outflow of cash will be put in bracket or put in parenthesis, where that will show that the money goes out. So if you see that whatever bracket here is showing that there is an outflow or cash payment, so you need to go and show the detail of the cash payment relating to acquisition of property, plant and equipment. How much is the cash spent? How much is the cash used for the purchase of IP, investment property, for the purchase of intangible asset, for the development expenditure that is capitalized under IAS 38, MFRS 138, and also the acquisition of biological asset using cash. So those has to be put separately here. And you should have a special rule for each of those items, right? And that should be an outflow. Earlier we talked about disposal. Disposal is an inflow. This inflow means you debit your bank account, you credit your investment, for example, if you dispose of your investment. You may also have acquisition of investment. Yeah, acquisition of investment. Let me just remove this for a while. Okay. You may also have acquisition of investment, and as I said, acquisition means the one that you credit to your bank account, yeah, and the one that you debit to your investment. You may have to go and open up your investment account. You may have to reconstruct those balances in the account. You may have to go and check the accounting records to do that. And you need to also consider if there is some thing that relates to non-cash effect, because we are just focusing on cash payments, yeah, but as our journey to find that, we may have to also exclude some non-cash transaction or non-cash items. You may come across another one, which is this is quite common. If you have rental that you receive from your property, which is your investment property. Let's say you have your building or your land and you have it being rented out, and that is not your main business. Your main business is not to rent out the building or land, but you do have investment property, so you try to generate the economic benefits or try to generate future income by having the building or the land being rented out. The building that is being let out, which is not the main business of the entity, is a source of investing activities. So that rental income is what you will debit bank and credit rental income. Yeah, that was your going to be your investment property item under rental receive, and that will be your again your inflow. The next one is dividend receive. Okay, dividend receive, you have an option that you can show the dividend also as part of the operating activities. Under MFRS 107 or IAS 7, the cash flow, the dividend received and dividend paid shall not be shown at the net effect. Dividend received must be disclosed separately. You have to disclose the dividend received here in the investing activities, and the dividend paid must also be disclosed separately. So if you look at the bottom here under financing activities, which is our section 3, there is an item of dividend paid. So dividend paid must be classified under financing activities, and as what we have here, the dividend received must be disclosed separately. It shouldn't be the net effect of the dividend received versus the dividend expense or dividend paid. Interest received, the same thing. It shall be disclosed separately. You may have interest paid, you may have interest received. You shouldn't show the net effect of those two. You need to show them separately again. And here I put it under investing activities. You may also have them or have some company disclose that under the operating activities. Right. Those are some of the common items that you may come across. Under investing activities. So the result of this total coming from your investing activities, I call it U. And if you have a negative result, that signifies your outflow. If you have a positive result coming from the total of these activities under investing activities, that is going to be an inflow. So the net cash from is an inflow. The net cash used in investing activities is an outflow. So you have the section 1 done, or the section 1 that I have explained, which is called U. So you need to find the U. Then we move on to cash flow from financing activities. What are cash flow from financing activities? Cash flow from financing activities, it refers to those activities that result in changes in the size and composition of the company's equity, share capital or contributed equity, share capital and reserve, and the borrowing. So any increase or decrease in share capital and reserve, any decrease or decrease in your borrowing, which is your non-current liabilities, of the entity that brings in or utilize cash is our focus now, right? Meaning that whatever that is using the cash and whatever that is bringing in the cash to the company, which are under financing activities. For example, these are under the standard. It says payment of dividend. It is under financing activities. Cash proceed from issuing shares. These are example of the cash receipts under investing activity, under financing activities. For example, if you issue share, you debit bank, you credit only share capital. If you have a right issue, you debit bank, you credit the right issue, or you credit only share capital directly. Or if you have some cash proceed from the issuance of debentures, and the list goes on. These are actually the source of cash inflow. Payment of dividend is the cash outflow or cash payments, cash that goes out. You may also come across, these are from the standards, cash payments to redeem preference shares and debentures. These preference shares, redemption of preference shares is normally included as redemption or the repayment of non-current liabilities. Yeah, but the debentures as well. So if you issue debentures, it was your liability. So when you repay them, that is an outflow of cash that you are interested. What you credit to your bank account to redeem the preference shares is our focus. Cash payments to repurchase own shares. So we'll be looking into that. Yeah. And you need to put this in your separate line item here. Right? Cash payment on purchase of own shares. On the exercise of share buyback, you may have a cash payment that you purchase your own shares for cancellation. That is going to be included under financing activities as an outflow. Cash payments that you may have to make for the loan that you took earlier here, or for the notes that you issued to your supplier, yeah, so to repay that long-term notes, bonds, mortgages, and other short-term or long-term borrowing, right? The short-term borrowing, short-term loan, yep, right? It has to be put under the financing activities, and also to repay the long-term borrowing. So here you have the detail of each of the item that I mentioned. Yeah, the right issue, it is going to be your inflow. You are interested to know what is the amount that is debited to the bank account and credited to the share capital account. This one, what is the one that give the cash receipts? What is debited to the bank account and credited to the debenture account, which is at the fair value. You may have to reconstruct the T account to find those missing cash receipt. Yeah, you may have to reconstruct that also to find out what are the payment of cash that you make to acquire the shares, your own shares, during the exercise of share buyback. So whatever that you credit your cash, right, account, or you debit the at the next account, which is the opposite account, that would be your cash outflow, cash payment. This is what we are looking for. And cash flow from financing activities, as I said, is focusing on the changes in the non-current liabilities and equity. Equity means share capital and reserve. We need to focus on that to go and trace what are those transactions that relates to bring in cash or bring out cash. Cash payments for redemption of preference shares, cash payment for repayment of loan. Yeah, remember when you repay loan, you will normally repay together with the interest. So the interest paid, you will put under the operating activities. So I'll show you this here. Yeah, will be put under operating activities. But the amount that you pay to the bank for the loan, that one is going to be put, or the payment of that will be put under the financing activities. So this is, for example, credit bank, debit, loan. The next one is cash paid for repayment of debentures and borrowing. So if you issue debentures to finance your company, if you take long-term borrowing, at the end of the day, you may have to make repayment. So as I said, repayment are an outflow. You can put here a bracket with the figure inside it, or you can also put negative sign. Negative 100,000, for example, shows an outflow. If you leave the figure as it is, let's say you issue shares for 1 million, and you debit bank, you credit your share capital, right? That one will have to be left as it is. So the figure as it is shows an inflow, which shows that the bank has been debited during the year for that total of, let's say, 1 million in the issuance of shares or shares capital. And if you have the cash payment for the loan, let's say the total loan that you pay during the year was 100,000 throughout the year. So that total in that year relating to the cash payment is what that you need to show as an outflow, or put the figure in bracket. or leave that as a negative figures there. Cash payment also will involve some dividend paid. Dividend paid, you have an alternative that you can also show dividend paid as cash flow from operating activities. Go and check the standard. Standard give this option of showing either under financing or under operating activities. After that, you will come across another total from the section 3, which is cash flow from financing activities. And let's say you have an inflow. If you have an inflow, you will need to show as it is, and that is net cash from financing activities, that I call it as. And if you have an outflow, if let's say you actually pay more for the liabilities as compared to what you receive from the issuance of shares or from loan that you took, so that will give you a negative figure. That negative figure shows that you are using more of the cash for your financing activities on the side where more cash is being utilized, right, to make payment, right? And then as I said, these are the section 3. So now whatever that does not mesh in section 3 and section 2 will then be put in section 1. So if you go and watch my next video, I'll be explaining how we do that. But before that, under cash flow from operating activities, which are section 1, if you see here, it says other activities that are not investing or financing. Whatever that does not fit into investing, whatever activities that do not fit into financing, they may be, or they have to be put under the operating activities. Cash receipts from customer. Okay, the first item, you need to show the cash receipt from customer. So the cash receipt from customer are normally derived from the sale of goods and rendering of services in your ordinary course of business. If this is a business that manufacture or sell goods to the customer, or if you don't sell goods, you provide services. So the receipt from your customer is what you debit in your bank account and what you credit in your receivable account for the payment that were made by the customer. And normally this is as a result of having allowed them to buy on credit, or you allow your credit sales relating to them. What are the source to track this cash receipt, or what is being debited to the bank account and credited to the cash receivable? You can track them by comparing balances in account receivable, and if there is any allowance for impairment of that receivable, there's a typo there, can you just remove that end there? So you need to go and track the comparative balances which from the prior year given, and the balances for the current year, because when you prepare cash flow statement, you normally be given a comparative balance sheet or comparative statement of financial position. You need to adjust the sales to find out the credit sale. Sometimes you're just given the sales. Bear in mind that we're not looking at the cash sales, we are looking at the credit sales, right? The credit sales. And as a result of looking at the credit sale, we are trying to find out how much out of our credit sales that we managed to collect. That is cash received from customer. You need to go and adjust that credit sales to identify the changes in the account receivable, which will relate to cash received. So you have to reconstruct the account. So I show a sample of the reconstruction of accounts. Yeah, I'll just show you some example of it. You may have to do something like this, like what you can see here in my my step 5 that I will be discussing when you discuss the preparation of cash flow using the direct method. You may have to reconstruct this again. We'll be doing that in our next video. But we go back to our template, the discussion. So we need to find that in using our T account, which is the way we do in class. Right? I know in practice they use the worksheet, but we're not talking about what was so much done in practice. We're trying to put this into educational purpose, which is to guide those who are beginning to learn how to prepare the cash flow statement. Now we move on to the next one, which is cash payment to suppliers. Cash payment to suppliers is the reverse case, where you make payment to your creditors for the goods that you purchase or the services that has been rendered by them on credit in their ordinary course of business. Yeah, in the ordinary course of business. What are those things? Right? These are, for example, you can track them from your SOPL and SOFP, and as well as any other accounting records available, like your additional information. You need to do the same, track the comparative balances of accounts payable and the inventories given in the statement of financial position. Adjust the changes in inventories relating to the purchase and cost of sales. We need to do that because you want to find out the credit purchase. If you find out the credit purchase, later on you can identify the changes in accounts payable that relate to the cash payments to suppliers. I show you a sample here. We are trying to do this. Actually for cash payments to supplier. Earlier on, we talked about cash received from customer. We're trying to find this one in the green section there, the cash that you receive. We're trying to find this. We will do that later. And then the next one is cash payment to and on behalf of employees. Yeah. What are those? Those are those things that derive from derived from salaries paid to the employees. The employees are the one that relates to the companies. You want to know how much is the cash actually paid to the employees, because MFRS or the standards require that to be disclosed. So you have another line for cash payments to employees. So the first line is on cash receipt, the second line is on cash payment, and the third line is also on cash payment. And that cash payment is whatever under operating expenses. Operating expenses are distribution and admin expenses that you paid. You credit your bank account, but you need to go and adjust, because in the statement of profit or loss, where these are being presented, the expenses, right, they may have also included the non-cash and non-operating items. So you need to make adjustment for these non-cash items and non-operating items. Non-cash and operating items are, for example, items like depreciation, items like gain or loss on disposal, items like non-operating item, right? Items which are investing or financing activities, but it has cash effect, just like your dividend income and interest income. So that has to be excluded, right? And when we talk about non-cash item, we will be talking about that in detail later when we prepare the statement, right? But just to share with you, non-cash items, the common items are the depreciation, loss on disposal, gain on disposal, the deficit on revaluation, the amortization of asset, the impairment loss, the changes in the fair value, which relates to gain or loss on the investment properties, and there are many more. But the common one is the depreciation, the loss on disposal. Yeah, those are the one that you normally include, right? And relating to foreign exchange, any loss or gain on the foreign exchange, different. They are also non-cash items that may have been included in the preparation of profit or loss statement. You need to do that adjustment. The next one is then you will get your cash generated or cash generated from the operation. If it's a negative figure, that is the cash used in operation. If it's a positive figure, that is a cash generated. Find your income tax paid, what actually paid to the inland revenue. Yeah, what was actually credited to settle the tax payment, tax due to your inland revenue. And also you have interest paid or finance costs that you have paid during the year, maybe the one relating to bank overdraft, interest paid relating to the loan and borrowings, or maybe here can also include finance costs, which relates to maybe the dividends on redeemable preference shares paid. After you have done that, you get your total that I call Y. The total Y is net cash from operating activities. If it's a positive figure, if it's a negative figure, it is the net cash used. So you have Y as your total from section 1, which is operating activities. You have U, which is your total from section 2, coming from investing activities. You have S, which is total from financing activities. And this total is what you call, if you total up Y plus S plus U, YUS, right? Y plus U plus S. That is called either net increase or net decrease in cash and cash equivalent. So if it's a negative figure, that is a net negative figure. Yeah, that is a net decrease, right? And that would represent, just want to show some information here for you, because I have some notes written here. So this will represent the total from the net cash used in those 3 types of activities. Let me just put it here. Okay, this is the thing that I want to show you. Okay, this Y plus U plus S, which is the total from the 3 section, represent the total from operating, investing, and financing activities. And that also represent the reconciliation of the opening balances of cash and cash equivalents with the closing balances of the cash and cash equivalent. So cash, can be cash in hand, cash in bank. What are cash and cash equivalent, right? That might be the case. Cash equivalents. So you're going to look at what are the opening balance and what are the closing balance. And the changes in that opening and closing balance will be represented in another note that I put right under the cash flow statement itself, which is note on cash and cash equivalent. So what are the source for the cash and cash equivalent? It can be cash, yeah. Cash can be cash in hand, yeah, and can also be cash in bank or any demand deposit. Cash equivalents, or these are like your short-term investment, which are less than 3 months. Highly liquid investment like your marketable securities that can be converted into cash that are subject to an insignificant risk of change in value. It also includes bank overdraft. Bank overdraft will be put as a negative amount or as an outflow. So these are the example of cash equivalent, bank overdraft. Cash at bank, cash in hand, these are all under cash and cash equivalent. Any short-term investment which marketable securities which are within 90 days period will be put under cash and cash equivalent. So you need to make sure that I put here, you need to make sure that your total here will match with the total here at the bottom here. So you can see the arrow there, right? So now what you need to do is list down all your cash and cash equivalent that you have. Put the beginning balance. Beginning balance can be obtained from your SOFP, statement of financial position, your balance sheet. The ending balance, the closing balance, you put it here. Put it in detail, each of the item, right? Find the total for beginning column, find the total for the ending or closing column, and then find the difference. The difference here will be the net increase or net decrease. If the beginning balance exceed the ending balance in total, that is a net decrease. And net decrease will be put in negative sign here or in bracket. If the ending balance are more than the beginning balance in total, I'm also doing it for each of the item if you see, but what is more important is this. Let me put the color here, which is the green color so that you won't get confused. Yeah, this one. Yeah, I'm talking about this green here. I put them, bold them a little bit so that it can be clearer to you. Okay, so the total that you get from the three activities should match with the total that you get from the net increase or decrease of cash and cash equivalent. So you can find the answer to the cash flow by first constructing them first. Constructing the cash and cash equivalent. You can do this first. There is no one best way. You can always do this first. Get this total, put this total here as your net decrease or net increase in cash equivalent. The total of this column, which is also in green here, right? I put green for you. The total here is green. Sorry. Here, this one, yeah. Green, yeah. See. Okay. Why is it not going here? Okay. Sorry about that. Okay. The total here. Remember the total here? This is what? This is actually the total from beginning of the year. This is the figure here that I put here. The figure here is derived from here. The figure here is derived from the ending column. So that's why you have here cash and cash equivalent at the beginning of the year. And this one is cash and cash equivalent at the end of the year. And that is the total that you will get by constructing the cash and cash equivalent schedule first. So why not go bottom up by preparing the cash and cash equivalent so that you will build your confidence that you know the answer to the cash flow. You will know Y plus U plus S through the statement of cash and cash equivalent. So this one, you will get it first, right? Through the statement of cash and cash equivalent. But at the end of the day, you should know the total should also match with the total coming from operating activities, investing activities, and financing activities. If it does not tally with the total there, something is not right somewhere. With that, I thank you for watching. We'll go in our next video looking at how to prepare the statement of cash flow using the direct method by the help of the T accounts and some 6 steps to do that. With that, I thank you for watching. I hope this have given a very thorough introduction of what a statement of cash flow would be presented if it is using the direct method. Okay, if it is using the direct method, let us just have a recap of the statement here. All right, here, if you can see, these are the thing that should be included. Okay, these are the so-called template that I'll be using. These are the template. Okay, thank you for watching and do keep in touch with me in my next video. Assalamualaikum warahmatullah. I'll see you when I will see you.